All right. And we're going to go ahead and get started now and talk about the new acquisition here called Braxton, Cary, Weston, which is located in the Raleigh, North Carolina MSA. And as we get started here, I want you to find your chat box, but also find your calendar link and be able to, not your calendar link, excuse me, but your Q&A box so that we can go ahead and do a check here on the video as well as the audio. So go ahead and raise your hand there. Let me know if you can actually hear me very well, and raise your hand if you can see the screen so we can make sure that everything is doing a quick sound check there. Perfect. Good. Thank you guys for participating there. And all right, I'm gonna go ahead and lower your hands as we get started. Then Mark's saying there as well. You can see the screen. Appreciate that. And this particular acquisition is an acquisition that's very close to one of our other acquisitions that we've had last year. We'll talk a little bit about that one today or tonight on the webinar. But before we get started, I want to go around and do some introductions of our team. So I am Dan Hanford. I'm one of the managing partners here at passiveinvesting.com. And we will, and I'm getting confused here because normally I have my team on the screen. And I kind of see them at the same time. And I don't know where they are. Anyway, so I want to tell you a little bit about me for those of you who have not heard about me before or heard about our group, and give you a little bit of an introduction. So I am located here in Columbia, South Carolina. I'm married, have 4 children. Actually, all 4 of my kids are under 10. So I have a 9-year-old girl, 8-year-old boy, a 4-year-old girl, and a 2-year-old girl. So life is busy here in the family. And of course, we also have a standard poodle named Bella. So we have a pretty busy life here. And my background is actually in running medical businesses. So I actually have 4 non-surgical orthopedic medical clinics that I own and run. I don't run a lot of the day-to-day operations. I have a good team that actually runs and manages that piece of it for me, or for my wife and I. And so we don't have to go in and do a lot of the day-to-day operations. We have a corporate meeting once a month with our team, but we have a good CEO in position there that runs things there. And then we also have a couple other companies that do a couple of different things as well. One that does one that actually is called shopanatomical.com. We sell a lot of anatomical models like skeletons and skulls and brains and hearts. And we have had that business now going on 13 years. And we have been together as a team here since the very beginning at passiveinvesting.com. And one of the things that I think is important for you to understand is kind of each one of our roles as it relates to the company. So my kind of focus is on investor relations and also on the marketing aspect of passiveinvesting.com, but also overseeing the marketing as it relates to our properties and our assets that we acquire in our portfolio at the same time. And then I'm going to go ahead and turn it over to Danny, let him go ahead and do his introduction, and then he'll turn it over to Brandon when he's ready as well.
I am Danny Randazzo, the financial lead here at passiveinvesting.com. My background is in financial consulting. So I worked for nearly a decade traveling around the world and the United States, helping multi-billion-dollar companies improve their financial performance and business operations. One of those assignments actually took me over to the United Arab Emirates, where I had the opportunity to work with the second largest sovereign wealth fund in the world, the Abu Dhabi government, in setting up the financial operations for the Cleveland Clinic Abu Dhabi health system that recently opened a few years back. I was on the ground early for that assignment and helping there. So my background is really all about the underwriting, the analysis, the asset management. I started really investing in real estate kind of one property at a time alongside my wife. The two of us reside in Charleston, South Carolina, so about an hour and a half or so from Dan and Brandon in Columbia. We have a golden doodle dog named George, and we love taking walks with him around downtown Charleston. Another important fact about our team here at passiveinvesting.com, I have known Dan for probably about 5 years now. We met through a mutual mentor, and he and I quickly hit things off, just kind of being on the phone and doing podcasts with one another. And then very quickly we met for breakfast, kind of halfway in between, and Brandon came along for that ride. And it's been a tremendous working relationship and really a friendship. We really started out trying to help each other as friends excel in the real estate business, and really started to just build a friendship as opposed to trying to partner in on real estate opportunities from the get-go. And so over several years, we built that relationship, and then eventually got into one deal, and then we bought a second deal. And now we're on to, many more deals. I think we've got about 275 million, almost 2,300 units in our portfolio. All of that information is in the appendix of the offering memorandum. So you got an email probably from Dan with a link to the offering memorandum, the investment summary, and our portfolio and kind of experience and track record is in there. So again, I'm Danny Randazzo. I'm over the financial aspect of our operations and the asset management. With that, Brandon, I'm going to turn it over to you.
Good evening, everyone. I'm Brandon Abbott. I am coming to you this evening from Las Vegas, Nevada. My family is in the room next door. I'm in a hotel, so different background here than you typically see me in. We are getting ready to go do some sightseeing of the Grand Canyon and some other great geographical locations in the West. So we're excited about that. So I live in Columbia right next to Dan, not right next to Dan, but right in the same city as Dan. And as Danny mentioned, just about an hour and a half from where he lives. I have a wife and 4 daughters. My oldest is 15, and then it's 13, 12, and 9. And then we have 3 dogs and 4 rabbits. So we have a house full there. My background is in residential construction on the GC side and also on the contractor side. And then the last 8 years before I went full-time into real estate investment, I was involved in insurance adjusting as an independent adjuster. I would adjust claims for property and casualty, that's cars and houses, hurricane damage, hail damage, different things like that, and really gained a lot of knowledge about estimating construction costs. And then my background in construction really gave me a lot of that knowledge as well. So my role with the company, with PassiveInvesting.com, is with acquisitions. And so I nourish the broker relations, if you will, and get to know them better, let them know who we are, and we work together to put out a search criteria for the type of properties we're looking for. And then I put that out to the brokers and just keep in touch with them via phone call and email and different things until we find the right one. And that relationship has led us to this particular property. This is an off-market deal. And so we're excited to bring it to you tonight. And with that, I'll give it back to Dan.
Thank you, gentlemen, for those introductions. And before we get started, I want to mention a few things. So I'm going to for our legal team, I'll go ahead and put up our disclaimers here. These are also listed inside of the investor offering memorandum package that we sent out via email that you probably received by this point. And here's another little slide for some additional disclaimer information here as well. One of the things I do want to mention is that this offering is only open to accredited investors. And typically, the definition of an accredited investor is somebody who has met one of 2 criteria. You have to have either met an income or a net worth requirement. So the income requirement is $200,000 or $200,000 if you are single, $300,000 if you are married, and that is of annual income for the last 2 years, and you have a reasonable expectation for that to continue. And if you are trying to meet it by the net worth requirement, then you have to have at least $1 million of net worth. That does not include your primary residence. Now, recently, in the end of August, the SEC has expanded the definition of the accredited investor statute or regulation. And so we're not going to get into all the details of that. But if you go to Google and you type in expanded accredited investor definition, you will find articles that explain what those additional things are. And if you meet one of those criteria with this deal, you are able to invest with us, because this deal is actually closing after the 60-day period of when that expansion of the definition goes into place. So it actually goes into place like the end of October, and this particular acquisition is being closed in the first week of November. So just keep that in mind. I know several of you have already emailed me and said that you don't meet the income or the net worth requirements, but you do qualify based on the expanded definition. So if you're curious and you want to check that out, you can certainly do that. And if you have questions about that, feel free to shoot me an email. I'm glad to be able to help you out when it comes to that particular status. But this is a 506C, 506 Charlie. And so we are only allowed to accept from the SEC these accredited investors. So that's all with that. So going into this deal, we're really excited about it. It's called Braxton, Cary, Weston. Actually, right now, it's called Hudson, Cary, Weston. And so if you go to look up the property, just make sure you change that to Hudson, Cary, Weston. But we're going to be rebranding it and naming it Braxton, Cary, Weston. And so you can see the address there on your screen there. It's 288 units and built in 1995. They started doing some renovations in 2016, only did 50% of the units since they've been holding on to that property. Kind of been doing a few units every single year up until this point. They've now proven the model of being able to renovate those units and achieve the rent premiums that they were looking for. And so we're going to be taking over and completing that. Brandon will get into a little bit more detail as far as what we're going to be doing as far as the renovations are concerned. This one has a historically high occupancy, which is great. Right now is 97.2%. I believe that was a number that was updated as like at the end of August, like August 26, but it has continued to maintain that. One thing you'll notice here, and we're going to touch on this a little bit on the Google Maps tour that I'm going to do with you, but Brandon will also touch on it when he shows you the drawing or the rendering of the site plan as well, that this is a very large property. There's a lot of space on this property. It's 32.7 acres. So it's very, very wide, very expansive. And so you're going to see that, which makes it a very welcoming property where a lot of residents like it because it's not just crammed in there it's not just like crammed in like you see some of the newer properties that are being built right now. And it's really, really nice how it's kind of all laid out for the residents. So a little bit more about the demographics as we dive into this. So you can see here, it's been a 30.84% growth within a 3-mile radius of the property since 2010. And that's just expected to continue. You can see some of these projections up until 2025. We try to outline here for you in the offering memorandum, a 1-mile, 3-mile, and 5-mile radius of the projections in near this particular property. This data is actually given to us or provided to us by CoStar. So we have a subscription to CoStar, which allows us to be able to pull a lot of this information in. And so you can you can look through here and kind of see one of the things to kind of highlight here is the average household income, and a 1-mile radius is 113,000, 108,000 3-mile, and 112,000 in a 5-mile. So it's a very high end area. It's a very nice area, A-class area. This is a B-plus asset. So it's very similar in kind of makeup as our Carrington at Briar Creek property, which has fared well even during the COVID-19 pandemic in that particular market. It's only about a 15-minute drive from that property between these two properties. So the nice thing about that is that we have some economies of scale that we can actually benefit us, and being able to, maybe share some of the staff between the two different properties, but also being able to share the ability to get, recommend a neighboring property if for some reason that particular property is full, or maybe they're just too far away from where they want to live, and they can recommend the sister property, which will be nice to be able to have that economies of scale right next door. We'll talk about the management company towards the end. The same management company is going to be managing this asset as with the other one as well, and that one's called Carrington at Briar Creek. A couple things to point out here about the jobs. I don't know how many of you know about the Raleigh, Durham, kind of Chapel Hill market, but it is a very expansive market. It's growing rapidly, and there's a lot of tech jobs there, and a lot of it is driven by the Research Triangle Park, which is the country's largest research park, and it has over 50,000 jobs that are located right there about 10 minutes from this property. And it's not just 50,000 jobs from one company. And that's the neat thing about that research park. It is several dozens, if not over 100 different companies that have a pocket or an office located in there. And there's also some large corporations that are in that Research Triangle Park as well that you will have heard of. And we listed those inside of the offering memorandum as well. But you can also go to rtp.org and find out more information about that research park, which has sparked a lot of growth in that market. And of course, there's 3 top-tier schools in that market as well. So we're going to be doing a two-tiered equity structure on this particular acquisition. As you can see here, you can see the capital stack and how it is outlined. And we're going to be doing on Class A, which is right next to the senior debt, they're going to be receiving a 9% preferred return. It's going to be paid out monthly, and that will start in January. So we always wait until we have a full month of operations under our belt. And so we will be closing on this property in the first week of November. And so we'll wait until we have the full month of December under our belt. And then January will actually be, as long as everything goes as planned, the first month that we'll do distributions. And so the January distribution will include the prorated portion that we own the property in November, and then the full month of December, that will be that January distribution. And then ongoing after that, there will be monthly distributions ongoing. And same thing with Class B. Class B will also get a monthly distribution, but it will be there's a 7% preferred return, which you can see on page 15, which is the next page we're going to see here. Is actually 13 in this slide deck, but in your slide deck, it's actually page 15. You will see the annual returns year 1, 2, 3, 4, and 5 for the investors in Class B. Now, one thing to note is that we always do a cumulative preferred return, which means if for some reason we don't hit the preferred return one year, that lagging preferred return rolls over to the next year and the next year until you are made whole. And so you'll also see that there's a table at the bottom for different sensitivity analyses in there based on exit cap rates and what the assumptions are going to be for you in regards to the IRR, the internal rate of return, but also the cash, I mean, not the cash on cash, that stays the same, but the equity multiple and the annualized return as well. But one other thing I wanted to point out here is that the Class A investors do not participate in any of the upside, which means when we sell the asset, the Class A investors, they have preferential treatment, so they're going to get their preferred return paid, and then the Class B, if there's any lagging preferred returns there, they would get those preferred returns paid back as well, and then the Class A investors would get their capital back first, and then the Class B investors would get their capital back after that, and then the Class B investors will share in a 70-30 split with us as the general partners on the property, and then there is a secondary hurdle, which you will see disclosed inside of the PPM, which is a 13% IRR. So once the Class B investors hit a 13% IRR upon exit, then there will be a 50-50 split. So it'll change from 70-30 to 50-50. This might sound a little confusing. Don't be confused about it. Inside of the PPM that you'll receive, once you submit your soft reserve, you will receive those documents, and it'll easily outline that word for word inside of there as far as what happens on the cash flow distributions, what happens on the disposition of the property, or if we decide to do a refinance on this property, if it makes sense, or not really a refinance because this is a permanent agency debt, but more of a supplemental loan, then that will be outlined in the PPM as well. So let's do this. Let's move over to this next slide here. I'm about to turn it over to Brandon, but before I do, I want to do a quick property tour with you on Google Maps tours. Give me just a moment here. Let me close this down. And first thing I want to do is share with you the property drone footage that we did on this property. I'm not sure if you're gonna be able to hear any of the audio, but it's only a 1-minute clip that we can kind of see a flyover tour of this particular property. So let me get a new screen here set up, and there we go. So let me see if I can get the sound, share computer sound. So let's do this. You should now be able to see the video. I'm going to go ahead and press play here so you can actually see this. All right. So let me go ahead and change the screens here to our property tour. Give me just a moment here. And we're going to do a quick property tour so you can kind of see exactly where this particular property is located. So now on your screen here, you should be able to see the Google Maps tour. And so what I like to do first when we do these tours is kind of zoom all the way out just so you can kind of see where this property is located. And we're actually located, I say we, but myself, I'm located here. Go ahead, Danny.
Can you bring the feed onto the screen?
There we go. How about that? Is that better?
Perfect. Thank you.
Thank you so much, Danny. So what you can see here is we're located here in Columbia, South Carolina. Obviously, Brandon is way over here in Vegas right now, but we live here in Columbia, South Carolina. Danny's down here in Charleston. We have Charlotte right here. And then here's that Raleigh-Durham, Chapel Hill kind of MSA called the Triangle area. So I'm just going to kind of zoom in here so you can kind of see where this particular property is located. As we zoom in, you're going to be able to start to see a couple of things here. So here's that Chapel Hill area. Here's the Durham area, and then you have this downtown Raleigh area as well. The Research Triangle Park is actually just north of the airport. So here's the airport right here. That's RDU, the Raleigh-Durham International Airport. And the Research Triangle Park is just right here. So the property itself is about a 10 to 15 minute drive from the Research Triangle Park, which is what we talked about earlier on. And then, of course, here again is that airport as I zoom in as well. One of the things you'll notice is there's a lot of different retail and shops and things like that are around here. You also have NC State University sitting here. And then as we zoom into the property, you'll be able to start to see a few more things that is really good for the property. So there's actually this Lake Crabtree right here. And what's nice about it is that this particular property is actually on this trail that actually goes to this Lake Crabtree area. And there's a lot of natural trails and walks and wildlife that are out there near this particular lake. And the city has done a great job of kind of, keeping that, nice and clean for those who like the outdoors. And it's very close. It's an easy walk to the property from there as well. One other thing I wanted to point out while we're here is this particular area. We mentioned in the OM, the offered memorandum, about this company called SAS. It is an analytics software company, and they have over 5,000 employees, and they work 1 mile away from the property. So this is this huge complex. You can see that it actually goes all the way down here. There's a SAS building down here, SAS building here, SAS building here. So it's a very large complex that spans this entire corner here, and it's not that far from the property. You can see the property is right here. So another thing I wanted to point out about the property is looks like there's a limo service at the property there. Look at that. Probably one of the residents that has a limo is parked there or something. Who knows? But this particular property, you can see how wide it is, right? This is a very large property. It's that 32 plus acres that is on here on this particular property. And so Brandon's going to go over the site plan with you, so I'm not going to go into a lot of detail, but I just wanted to show you a little bit about the surrounding area because I think it's important as an investor kind of see why we're so excited about this property and why we feel like it's such a good property for us to be able to acquire. So I'm going to go ahead and turn it back over to Brandon and let him go over the property specifics. And then I'll have him turn it back over to Danny once he has finished there as well. So let me switch the screen back over to where it needs to be real quick here, Brandon, before I turn it over to you. And then you can go ahead and get started. There you go.
All right. Excellent. Thanks, Dan. And that drone footage was really helpful. And as we start going over what we're planning to do with the property, just hopefully you took some mental pictures of that when you were watching that. So I'll touch on a few of those things. If you want to go ahead and advance to the next slide. So we do a lot of value add. We always look for some way to add value. It doesn't have to be always in paint, cabinets, and countertops. It can be in other areas. One of the areas that we are working on is just testing different models and seeing what works, especially when it does come to cabinetry, countertops, drywall, different things like that. In this particular asset, the prior ownership had already completed about 50% of the renovations in this neighborhood. They did such things as quartz countertops, new cabinetry, completely new cabinetry, plank flooring, but it was like a glue down plank flooring, new light fixtures, new plumbing fixtures, and they did not replace the appliances. The picture you see here is a classic, but a little bit upgraded. So the prior owner had done some painting with the cabinets. You can see those black cabinets. That is not technically the classic unit. So it's just a little step up from that. But we are calling that a classic, what you see in the background. So we want to make the cabinets white. Obviously, that goes a little bit better with the modern look that we want to go with. We don't feel that the cabinets are in bad shape. They're very functional, but that painting is all that's necessary. And as we test the market and see what the market needs and what we see on the rent roll as to what we can achieve, we just want to achieve the maximum rent with the minimum amount of cost. We don't want to overdo the renovation. And so we're going to try out a few things, which is, like I said, cabinetry, solid surface countertops, plank flooring, plumbing fixtures, light fixtures throughout the interior units. But we're also looking at things like a few of the units have fireplaces, and they have like a nice stone hearth mantle. It's actually very kind of classy. And they're not really taking advantage of that, but those are popular. And so we're looking to look for premiums on such things like that. Dan, if you want to go ahead and advance the next slide. This is their renovated unit, and you can see kind of what they did with the tile backsplash, the quartz countertops, the white cabinets. We do not plan to follow that to a T for a few reasons, design mostly. We like the look, but want to change a few things and want to use our economies of scale that we have created as a company to produce renovations at a lower price point. So we're really going to focus in on that and achieve the maximum for the least amount of money. So that's just kind of shows you what they have done compared to, and you can see kind of in that slide off to the left there, the old unit. You can go ahead and advance. So this is just the unit mix. I'm not really going to go over too much here. You can go ahead and advance to the next one. I'll talk about the amenities in a little bit. There's your unit mix there. So a good mix of the 2-bedroom, 1-bedroom, the 3-bedroom being only 10%, but you know, it's still a good, as Dan mentioned, it's a low density neighborhood. So it is good for the families with the 3-bedroom units because they have a lot of space for kids to run around and play. They have the nature trails, and also for a lot of consultants and people that work in the research triangle. You can actually access some of that research triangle from that trail that Dan mentioned. So it has a good draw for everybody. The good schools, the low density, the proximity to work, proximity to downtown. So we feel that this is the right unit mix for this area. You can go ahead and advance. All right, so this is the layout of the property. I just want to point out a few things. One is that there's a lot of carports. So there's a ton of covered parking on these. So we're looking at creative ways to revenue these better. They are currently being rented, but a lot of people just opt not to rent them. So we're looking at some possibilities, different things that we can do to generate more income from all these covered parkings, because this is a very nice thing to have, all this covered parking. So we're looking at a few things like inclusion into the rents or different things on some of the bigger units, or, as an amenity kind of thing. So we plan to expand the income that the property is currently achieving from the carports. Also, the tennis court you see up in the right top there, that's pretty run down. It has too many cracks to really make it worth trying to reseal and turn back into tennis. And, I love tennis. I used to play it. My knees are not good enough to do it anymore. But it's in the South, it's pretty hot. And so it's just not as popular as it once was. So we are looking at some different options there to make that kind of a community amenity space, because it's so closely located next to the pool. And there is a nice access. You can kind of see that yellow little umbrella thing up in the top of the pool. That's kind of the cabana, but there we could connect a trail down to the tennis court, and that can be an amenity space, and then clear out some trees along the pool so that it's kind of one cohesive space. And so we feel that that is key to the success of a property, is creating that community feel so that it raises your retention rate. So people want to stay there because they love the property. They just love everything about it. They love the people. They love to hang out there. So we want to encourage that as much as possible, and that's one way we plan to do so. The pool deck was actually redone just a little over a year ago with pavers, so paved stones, like the individual, they kind of look like bricks, but paver stones all the way around that pool. Very nice. They have charging stations around, next to the pool chairs. It has a whole cabana with ceiling fan and couches. So very, very nice. There's also some other small cabanas around the pool. Right now they have them up because of COVID, but they have them on the property. One thing that is also very nice about this particular property is the size of the fitness center. So on that top side of the clubhouse is the entrance to the fitness center. It is larger than a lot of actual gyms that you would buy membership to. Has more equipment than them. I was blown away when I saw it. It just keeps going and going and going. It's massive, but we feel it's not utilized to its full potential. So we plan to rearrange the space, try to get a little more of the yoga space. There's also a nice little patio outside the clubhouse that is connected with the pool that you can do some outdoor yoga, different things like that. Again, just pushing things towards that community feel, wanting people to stay. And this is you see how large this property is. You see the playground right there, kind of just off center of the photo there in this big grassy area. That's really, really huge area. You could play football out there, frisbee, cornhole, anything you want. There's just a ton of space there. So it's really good for the having kids or just people that have an active lifestyle. With all of these roofs, and being a 95 vintage, a lot of people a question may arise, and I haven't been watching the Q&A box, but how old are the roofs, and are we going to have to replace them? So thankfully these roofs were replaced about 5 years ago, and we will not have to replace them in our hold period. They are 30-year architectural shingles, which are great. They look great. They're in great condition. I did inspect them myself. I go out, I shot some of that drone video, which is why probably wasn't the best video, it's a little shaky, but I bring the drone out with me so that I can inspect the roofs. We have third-party people that come in and do it as well, but I also like to put my own eyes on it. So the bones of the property are really, really good. When we first come in, you saw in the drone video, the trees are a little bit overgrown. We'd like to clear that up so you can see the buildings a little bit better. So we want to put some money towards that. We have that in our budget. Redo some of the landscaping, just spruce up around the clubhouse, new signage, obviously, because we're changing the name. And then one thing, and I don't know if we have the slide in here, is for Gigafy that we plan to do on this property, which is fiber optics. And the good news is that Google Fiber runs right to the entrance of this property. It's right outside the entrance. So that's perfect for Gigafy. They run the fiber into the buildings, and then we become the internet service provider, in other words. So we can charge the residents, and they just pay through us, and they can get all their streaming services and everything through the internet service that we have put on through Gigafy. So that's another value add that we plan to do with the property. But overall, again, that's a good summary of the CapEx. I don't want to take everybody's time up too much on this Tuesday evening, so I'll hand it back over to Danny.
All right, let's jump into the numbers on this deal. Let's go to the next slide, Dan, and we're going to go through some of the high-level numbers. We have a entry cap rate based on the T12, so the trailing 12 months of total performance. This is a good reflection of where the property is at. It's at a 4.37. And current occupancy 97.2, purchase price 57.6 million. We have a 5-year hold time. Total equity required for this deal 21.49 million. And then there is the breakdown between Class A and Class B total equity required. Let's move on to the next slide, please. Principal loan balance. So the debt that we'll be getting, it's agency debt. Freddie and Fannie will both be competing to win the business. So this is an estimate of where we think we'll come in at. We have strong relationships with both of the agencies, so feel very good about this type of financing. And ideally, we will do our best to try to beat this, but here's where we think we're going to come in at about 42 million, 10-year term, interest rate fixed at about 2.85%. So very, very pleased with where the lending and debt market is at right now today, especially with the agency business being very competitive. They have a lot of liquidity from a lender perspective to put money in the marketplace for great assets like this one, the Braxton, Cary, Weston. So let's go to the next slide. Okay, here we're looking at the pro forma projections for our entire hold period. Like I said, it's a 5-year hold. We've got the trailing 12 months of the seller's operation. So there's a couple of important things that I want to point out that make this deal a conservative one. So the first one being that first line item, the gross potential rent. As you can see, 4.3 million from a T12 perspective. And we're going to be very, very cautious and conservative in our value add and how well we can push income. So as you can see in year one, the same number is there, about 4.3 million. In year two, it's about 4.3 million. So one thing taking COVID into account is we've really stretched out the stabilization for this property. We're planning to renovate about 135 units or so, and we have stretched out the stabilization to be 20 months. That is very important because it gives us a lot of time to manage our inventory of units in terms of how quickly we need to renovate units and how much time we have to slowly roll these things out. From an operator perspective, we're going to try to roll these out as quickly as possible to maximize the revenue that's generated. But of course, being conservative in nature, we're going to give ourselves plenty of time to slowly make and achieve the business model set forth. So that's really important that I wanted to highlight from a gross potential income perspective. We're really keeping the same rents in place that they are already getting today, really for the next kind of 2 years, the first 2 years that we hold the deal. Another important item, just a quick distinction here, you will see a slight jump in the other income from the T12 to year one, and that's really that slow rollout of our Gigify service, which Brandon has already highlighted. An important one to highlight next is that loss to lease number. So we will roll out, which our management company, FCA, has done for us in the past, the daily pricing tool. And we are able to basically burn off the loss to lease because every time a unit becomes vacant, we are trying to rent it at market rent. And there is no loss to lease figure. The next item, again, being conservative in nature, if you look at that vacancy loss that occurs, it's about 280,000 currently today with the seller's last 12 months of performance. We're estimating to be a little bit more conservative for this first year and even into year two because of COVID. If something strange picks back up, if there's more holds or limiting on evictions or people stop paying, we have a lot of cushion here, a lot of conservative levers that we've pulled on this deal to make sure we can achieve and ideally try to beat this business model. So there is an increase in vacancy that we are planning to have happen. I hope it does not happen, but again, we want this to be a conservative investment opportunity. And so the vacancy is about 344,000 compared to the seller's actual of 280. Concessions and bad debt remain the same, or non-revenue units, very similar to the seller's performance. From a expense perspective, not a significant change in the numbers. R&M, or repair and maintenance and turnover, the seller really buckets those items together. So R2 repair and maintenance and turnover line items are very similar, a little bit more we're planning to have in our budget compared to the seller. The one area where you will see a good savings is in utilities. So the seller has utility expense of about $233,000. And what we're able to do with our agency loan, the lender actually does a study for us if we can implement green efficiencies and reduce electricity usage in the common areas of the property and water usage by 15% each. And so this difference, it accounts for a conservative 25% reduction compared to where the seller is at today. So we will implement some green efficiencies, both from a LED lighting perspective around the common areas and the property and the parking lots, and for the water and energy usage within the units. So it's a great way to protect the environment and also save some money on expenses. So I really enjoy when we can roll those programs out. Not a major difference between the admin, the marketing, the insurance, the management fee, and the property taxes is the last important piece that I really want to highlight here. You will see that taxes remain about the same for the first 3 years of our hold period. This property is located in Cary, North Carolina, which is in Wake County, North Carolina, and they reassess taxes every 4 years. So they do not assess at a point of sale or when a sale occurs. And in 2019, the new assessed value came out for this asset. And so the 2019 taxes, the 2020 taxes, and in our first 3 years of taxes will be set to this tax amount. And then in year 4, you see there will be a jump. We are estimating an increase in that tax assessed value in year 4. I think I covered all of the important items here on the differences between really the seller's current operations today and our conservative plan for the first few years of this hold period. So let's go to the next slide, please. Okay, from a rent comp perspective, when Dan was looking at that flyover on Google Earth, there are a good amount of competing properties in the area. There's plenty of population and job growth to support the various multifamily properties in the area. Here's a couple of properties that we'll be using for our rent comps based on like kind of amenities at the property, like kind location, and like kind of interior units. And so I feel very comfortable of achieving the business plan and the gross income from rents based on what our competition is doing. So let's go to the next slide, please. Couple of sale comps for the area. We are buying this property. I believe we are getting it at about $200,000 a door. And so that is a comfortable number based on some of these other recent sales comps in the area. So let's go to the next slide, please. Sensitivity analysis. So this is one of my favorite slides here. And what we calculate is based on our stabilized post-stabilization, where we're at from a break-even perspective, and it's 53% once we stabilize the asset. And what I mean by 53% is of the total units that we have on the property, 53% need to be occupied and paying rent in order for us to pay all of our expenses. This is a full load of expenses and our debt service. So I feel very good about this break even for the property in order for us to hold on to this asset regardless of what economic situations may be presented. Any any cash flow above that 53%, that's how we're paying the monthly distribution. So again, it's a conservative deal in the fact that we have a 53% break even occupancy, and any occupancy above that number, historically, the property has been 95, 96% occupied over the last 10 plus years. And so I feel very good about keeping that, maintaining it. Even through 08, it had strong occupancy numbers, which would allow us to continue to pay investor distributions. So feel very good about that. And let's go to the next slide, because the cap rate analysis is also on page 15 of the investment summary, which we reviewed earlier.
Before we move off of this, Danny, I want to touch on something that I think is important for the investors to understand, is that when we first underwrote this project with our kind of pre-COVID, if you will, underwriting, conservative underwriting standards, it actually came out to be about close to a 17% IRR for those Class B investors. And obviously, given the current environment that we're in, we can't just go off of all of our same pre-COVID numbers. And to renovate 50% of this property should only take us 12 months. But we decided that we wanted to expand that until at least 20 months to give us that extra time frame to be able to do that.
And as a frame of reference, if we really wanted to push renovations, we could likely get it done in about 8 months. At Carrington, just down the road, we're turning about 16 to 20 units a month, because that project is a full 270 unit renovation. So that's a big lift over there. And yeah, you're right that turning or renovating about half of these units over 20 months is very conservative, when I know our team can handle 16 to 20 units in a month.
Yeah, and then one other thing I wanted to point out too is the occupancy during renovations we increased as well. So typically on a property like this that's historically been around that 96, 97% occupancy standard, when you start to do a renovation to this level, usually we'll say let's underwrite it for a 7% vacancy during that renovation period. And we looked at it and said, yes, but COVID, right? And so just to have that extra layer of mitigation, we added an additional 2% there. So we're projecting to be at 91% occupancy during the next 20 months, basically, during this renovation timeline as we're doing these renovations.
Yep.
So I just wanted to point that out. So I'll go ahead and go to the next slide as we finish up.
Perfect. Well, that being said, real quick, FCA Management, they manage our assets in North Carolina. They manage the Carrington at Briar Creek, which is just about 10, 15 minutes down the road from this asset. They also manage for us in our Charlotte market assets as well. So very pleased to be partnering with them on this deal. And one other note to mention, in the appendix area, the last couple pages in the offering memorandum or investment summary, we have some market specific information just to give you an overview on what's going on in the Cary and Raleigh, North Carolina market. And with that, I will wrap things up and really open it up to questions. I have not been catching up on the Q&A box or chat box. So Dan, why don't you lead us off and tee up some questions?
Sure. Let's go ahead and do that. So one person is asking, do the sponsors have skin in the game, and how so? And so I'll go ahead and take that question real quick, because it is a question that we get quite often. It's a question that I always ask when I'm looking to place my passive capital with other operators. And the answer to that question is yes. So typically our group invests between 5 to 10% of the initial equity that's required. So we're raising around this particular one just at $21.49 million for this one. So we'll be investing between 5 to 10% of that. And the reason why it's a range of 5 to 10% is because it depends on the demand for the investment, right? So if for some reason we need to put in a little bit more money, we will. But if we have to back out some of our investment, make sure all the investors can get in, we'll do that as well. But at a minimum, we do like to stay around that 5% mark in order to invest alongside of our investors. And then as far as which class we put it in, Class A or Class B, we usually don't get a choice. So we usually just wait to see what's filled up. And so if all of A fills up and there's nothing available, we'll be in B. And if all of B fills up and there's a little bit of A, then we'll invest inside of the A class share. So we leave that up to what's available for us at the end once the investors have that opportunity to choose where they want to be. Next question that's coming in here is about, it's really quite probably towards Brandon about the floodplain zone. It says Drew's asking here about the western edge kind of touches that 100-year floodplain zone, but do you know anything about the floodplain zone or anything like that on this particular property?
Yeah, none of the buildings are within the floodplain, even though it touches it. It's a non-factor. If it was a factor, then you'd be required to have federal flood insurance on the property, which this one does not, and has been through the 100-year flood cycle within the last since 2014. So we have no concerns about the floodplain.
And one recommendation is about what about converting the tennis courts to garages? Ever thought about that?
It's not accessible that way because it's kind of elevated up above, and it really wouldn't be conducive to that. But as far as parking is concerned, we have all those covered parking. We're looking to do maybe some of the turbo chargers or superchargers for Tesla, because there's at least 2 or 3 Teslas on the property now. So not really convert the tennis courts to that, but really increase the parking that we do have.
Good. And I know I had sent you a text message about answering the question about the school system. So can you touch on that just a little bit as well?
Yeah, and let me pull that back up. So it's Cary High School, Reedy Elementary, and Reedy Middle School are the schools for that district.
It's a very solid school system.
And I pulled up the schools like in the general area, and there's like 38 this kind of school and 42. There's a lot of private schools. There's a lot of options right there. So yeah, very good place.
And Danny, a question towards you is a question that we get, a few times on each one of our properties about the prepayment penalty. There's actually a few questions in here about that. So could you touch on that prepayment penalty, which is really that yield maintenance? And there's questions around, how much is that yield maintenance going to be? And, what is that yield maintenance itself?
Yeah, the high level way yield maintenance works is basically if interest rates go down, in kind of that exit 5-year mark, you pay the difference between your interest rate and the lower interest rate to the lender as to keep their investors whole, right? Because investors buy the debt and hold it. So if interest rates go lower, there is a prepayment penalty consideration. So if interest rates go up from where they are today, then there's not really a prepayment penalty because the lender can lend our debt out at a higher rate of interest. And so they are continued to be made whole from that regard. So in the event that we're going to be selling in year 5, we don't know where interest rates are going to go. And so it's just a consideration of selling at a particular price. And if we need to sell at a higher price to cover a prepayment penalty, if there is one, or there may not be one. The other option we could have is to hold the property for a little bit longer and see if there's a change in the interest rate environment. And another option would be to sell the property and have the new buyer assume our debt in place. And so again, it's kind of one of those crystal ball things of where will interest rates be at the time in the future. I don't know the answer to that question. And so we just plan for it and make sure that we run the numbers and get a prepayment penalty calculated if there is one, and calculate into the sale price to make sure that we can hit the returns.
Another question in here for you, Danny, is a couple of people have asked the question about the delinquency status or collection percentage, things like that for the COVID-19 period for this particular property, and where you see kind of some of the continuing prohibitions or eviction moratoriums and things like that that have been put into place right now.
Yeah, this property has been a very strong performer. It's in a great market, great location. Residents have lived there. I believe the number is about 28 months on average. So it's a very long duration. People like to stay there. From a delinquency perspective, it's been very low impact. There have been a handful of folks that are doing payment plans and paying as they can. I know in the month of August, and timing is probably a really good thing for us. The month of August and in July, the eviction court systems were open. And so the seller was able to get rid of, like I said, a handful of tenants that either were non-pays or had issues in paying rent. And so they are gone from the property. And so from a bad debt perspective, it's been really clean. And I would expect that to continue because they get high quality people who qualify from an income perspective, a rental history perspective, and a criminal background check. And so again, it's a high quality asset, high quality area. I don't foresee any major concerns in COVID hampering with evictions or any kind of moratorium that may come down. So again, with the timing closing in the early part of November, we may have to deal with the eviction moratorium through the end of the year, but again, very low impact, not many people affected at this asset.
A question in here for you, Brandon, is, are we going to be using the same company to do the renovations that is used with the other sister property?
And so each one of our properties is like a new deal. It is a new deal. It's an individual deal. And so we get 3 bids. We obtain 3 bids on every single deal to make sure we're getting the best price. So that company will likely put in a bid on that, but we always look and make sure we're getting the best price.
There's a question in here about mention of how much there is in reserves. And I think, Danny, if I looked at the numbers, I think I looked at them earlier today. I think we have close to about a little over 1.4 million in operating reserves when we close. Is that correct?
1.7.
1.7. Okay. So I was a little on the low side. Maybe it was 1.74. No, something like that. So we have plenty of money in there as far as the operating reserves. And, you know, the reason why we do that is to make sure that we can mitigate any type of future capital calls for the property. We don't have to worry about that piece of it. And so we always make sure on all of our acquisitions that we have ample operating reserves, even though it does reduce the returns a little bit for the investors. I think all of our investors would appreciate being able to kind of sleep well at night, just like us, knowing that we have plenty in reserves if we actually need them, especially during a time just like this.
Yeah, typically reserves, you plan for maybe 4 to 6 months. With 1.7, we've got over 12 months of full expense burden. And so again, I feel very comfortable being able to, pay our expenses, pay our debt service, and have plenty of operating reserves to get through any sort of financial hardship we've experienced to date that we know of.
So we're going to take a couple more questions here. I know there's a lot of questions in here that we're not going to be able to get to tonight. So if for some reason we don't get to your question, please feel free to email one of us. We try to be as accessible to you as possible. I'll put our emails up there on the screen. So if you have questions about, Brandon's section, you can email him. There's my email there. And of course, Danny's as well. So feel free to reach out to us. We'll be glad to answer those. Going back to you, Brandon, question is about, do you renovate units that become vacant when they become vacant? And if not, do you raise rents even for the existing tenants after renovation?
So the typical plan is to renovate upon vacancy. So usually what we do is if we have a renewal coming up, we'll go to the tenant and say, we are raising rent. We want to renovate your unit. Hopefully we'll have a renovated unit they can just move into, and then they'll renovate theirs that they're moving out of. But either way, we need to push the rents up. But the normal cycle is we have a renovated unit available. We come to the tenant that's looking to renew. We tell them the price increase and show them the new unit. They move into that unit, and then they renovate theirs. their unit. And we have had some people that they just love the unit that they are in, and they do not want to move out, and they do not want to move from the property. And so we have even renovated in place. The tenants stay in the unit. We changed the scope a little bit, obviously, because of different liabilities and things like that. But we still raise the rents up to our pro forma rates. Anything you wanted to add to that?
Go ahead.
I was just seeing if Danny wanted to add anything to that.
Oh, okay, cool. And Brandon, one other question for you in here as well while you're on the mic there. Any other CapEx items that might need to be addressed during that 5-year period we haven't already touched on?
The short answer is yes. That's why we have reserves, because there would be something that we did not know or not consider, but that we just did not know about. But there are some things that we haven't really touched on, just little infrastructure things. We didn't see anything that's as of concern to us in inspecting the property. No rot or any kind of major issues like that. One thing that we're going to be keeping an eye on is some of the retaining walls with railroad ties around some of the property. Just keeping an eye on those. That's something we may have to address during the whole period. But overall, the bones are good.
A question for you, Danny. A couple of them here that I wanted to make sure we could address before we wrap things up tonight is what do you consider the largest risks that would challenge the financial plan, and any thoughts on the likelihood of those risks actually materializing?
The risks that would challenge from a financial perspective would be increased vacancy, really from an economic perspective, meaning people not paying. And so if let's just say our vacancy doubles beyond our 9% vacancy assumption. So we're at 18% vacant or 82% occupied in that kind of worst case scenario. And that's probably triple the rate of vacancy that we saw in 2008 for this asset. Basically, what we would pay all of our debt service. We would pay all of our expenses. We would be able to pay out all of the Class A distributions. And so in that event of higher vacancy, Class B distributions could go down, but they would be caught up because it's a 7% preferred return. So, typically financial crises occur for about a 12 to 18 month duration. And so if that occurred, you may have lower returns for a period of time, but when the economy stabilizes and occupancy normalizes, then your returns would start to catch up. So vacancy would be one thing that I would be concerned about, or people not paying. This is a higher quality asset. It's a great location. People love to live in the Cary submarket of Raleigh. It's close to a lot of amenities, and people want to stay there, and they're generally, good people. When the team was at the property during due diligence and unit walks, everyone was friendly. They've lived there for a long time, most of them, and so they want to continue to stay there. The other financial risk to the property, I would think if we're not achieving the unit renovation premiums that we expect, and we've got 20 months to figure it out. So again, I feel like we've taken that risk into account and said, hey, we're going to take longer to renovate these units because of COVID, because of the financial challenges we're seeing in the world today, and really making this investment a conservative one in nature. So, I think that could be a risk, but I feel like we've done our best effort in trying to mitigate a potential pitfall from slower value add renovations, or if we have to wait 12 months to start them because we're not achieving premiums today.
So another question for you, Danny, in here is about the average rent per square foot. Because I know we've had some questions about that. I don't know if you already touched on that a little bit, but those average, the average rent per square foot versus the comps.
Yeah. So the main thing to look at this property is there's a high number of one bedrooms. So one bedrooms rent for a higher price per square foot, typically, $1.50, $1.60, $1.70 per square foot. And so when you look at the entire property averaged out at Braxton, Cary, Weston, the price per square foot average across the entire portfolio appears higher because it has a 46% ratio of one bedroom units. And so that pulls the average up. When you look at the comps at a per unit type basis, so you break them down into the one bedroom comps only, the Braxton, Cary, Weston is trailing those competitors in terms of price per square foot based on a unit type. Being a one bedroom, they trail the competition in a two bedroom, and they trail competition in a three bedroom. So I feel very good about being able to achieve the minor premiums that we will be trying to attain. And again, looking at that pro forma income, the seller's currently looking to get 4.3 million in years 1. In year 2, we're expecting 4.3 million. And so it's really a long duration to get those rents up over that 20-month period that we've planned for. So again, I think we're conservative in being able to achieve those rents, and the comps support it when you look at it on a per unit type average.
Good. Well, gentlemen, I think that is all the questions we have time for tonight. I know several of you still have some questions on here that we were not able to get to, so feel free to email one of us. We try to be as accessible and as available to you as possible and very responsive. So if you have further questions, feel free to reach out to us individually or collectively, and we'll be glad to answer any questions that you may have. Thank you, Danny. Thank you, Brandon, for being on tonight, and hope you have a good night, and we'll see everybody on a future webinar.